Welcome to the Professor Lending Institute, where we make sense of housing economics and the home buying process. I'm Jordan Steffaniak, president of Professor Lending, licensed loan originator, and your home buying professor. In today's episode, I'm thrilled to introduce you all to my friend Matt Joy at Union Home Mortgage. We talk about a whole lot of things, including the distinction between lender paid and borrower paid, broker comp. We talk about the difference between retail and wholesale channels. We talk about how you got in the mortgage industry. We talk about how to grow your business. We talk about a lot of things. I love this episode. We're all about education here. There's not enough resources, especially for loan originators, for real estate agents, and for those in the housing industry, just to understand how everything works, how the mechanics work, and how everybody thinks about the process, how they got into it. All these sorts of things, I think, are an encouragement to people both in the industry and as well as consumers and borrowers who are trying to get a handle on how this stuff works and how it impacts them and benefits them. So definitely tune in for the whole thing. It's a lot of fun. Let's go ahead and just dive right in. So the first thing I want to know, Matt, is just a little bit about your background, how you became an account executive, and what exactly an account executive is.
Absolutely. Jordan, first and foremost, thank you so much for having me on today. I really appreciate it. I do not believe that there are enough platforms speaking directly to homeowners about this and working through this education process. So I appreciate you having me on. Yeah, my story, my path to becoming an account executive was definitely an interesting one. I started in the industry in 2009, and I actually was working as an intern at ESPN Radio here in Pittsburgh, PA. And I realized quickly that if I moved over and just continued to move on through that path, I wasn't going to be making a lot of money. So my brother at the time was roommates with a high up executive at Provident Funding. And I'll never forget, we were at a bar and he goes, hey, do you want to answer phones for a mortgage company for like $32 an hour, or for $32,000 a year? And I was like, yes, where do I sign? Like I said, this is '09, right? So yeah, the industry is in a weird spot. Jumped in, started at Provident Funding, and yeah, I was answering phones which is so funny because I didn't really understand the gravity of what was going on in the mortgage space in '09. I was just like, it's just a job, right? But I mean, we were talking to people that were going through the absolute worst of times in the mortgage and housing industry. Yeah, I was front and center as a customer service rep. So started doing that. Then I moved over into more of a sales function where we were at Provident Funding. We were going to expand, so we jumped in to do some sub-servicing for Provident Funding. At the time, they were Freddie Mac's largest wholesale lender in the country. Moved over, built a little bit of a sales team around me, and we actually used, at the time, it was called Lender Ven Fulfillment Services, which it's non-delegated correspondent. That was kind of our way in, right? So we were selling that to get into the servicing piece. We did a great job. I moved to Chicago, had a team. We had a blast with it, met some great people. And then from there, I did a little bit of a relationship managing when it came to that. And then I jumped in head first into the TPO, the wholesale space, which was, I moved over to a company called Ethos Lending. And in order for me to, kind of sustain my position, which at the time I was just kind of doing a lot of recruiting and bringing, new talent and new hires, both operationally and sales, into the space, I needed to start earning my keep a little bit. And I'll never forget that conversation. I moved out of my office and moved into the bullpen and started to become an account executive, right? So I was just pounding the phones, working with, a bunch of broker shops. This has got to be 2015, 2016. And, that's how I got into that space. And then I met you when we moved over, myself and a bunch of the guys that were at Ethos. We moved over and got Princeton Mortgage started. Princeton Wholesale started. Princeton Mortgage was already established, but we just started that out of thin air and had that thing rocking, man. We were, as you remember, we were going pretty aggressive with that. Got ourselves up to $1 billion in originations, and then had a new opportunity to come over to Union Home Mortgage, and this is where I'm at now. But yeah, so I've been doing the account executive role since 2015, but I've been in the industry since literally day one of getting out of school.
Yeah, so it sounds like, you like the hustle of the account executive role, right?
I do. It's kind of like an extreme sport in a way, right? So it's like, and I say that because, you have all different angles coming at you, right? And, you have the pressure of what you, the loan officer's feeling, and then I can feel the pressure that you're getting from the customer and then the realtor and purchase transactions. And then I have to be that middle conduit, right, between our operations staff. We got a closing date that we got to hit. Something just popped up. There's an underwriting condition here. Oh man, maybe we have to restructure this loan. So, there's a lot of that stuff that goes into it. So the thrill of that is definitely something that I chase after.
Yeah, no, I hear you. So I got into the mortgage industry like 10 years ago myself, and I got in on the retail side, and I didn't know anything about the wholesale side for a long time until our mutual friend sort of introduced me to Princeton, and I was helping do some processing on the side with him. And I was just kind of like learning by experience. But I think a lot of people still have no idea that there are two different channels, right?
Oh,
So
for
maybe
sure.
just help explain what the difference is between these two. What are the benefits between them?
Yeah, absolutely. And what's funny is that I actually started in the wholesale side, right? So, and then I had to learn, I was like, I don't even know what retail is. It doesn't even make sense to me. What do you mean? So yeah, the difference really is, that loan officer that you're reaching out to, let's say works at XYZ Bank, right? And that loan officer is captive to that bank's programs, that bank's rates, which is why you see a lot of, independent mortgage banks or just banks in general have a lot of different unique programs, right? They'll have the 203Ks and, some of the unique stuff, right? The bond programs and bank statements and all that stuff, because they really have to give their loan officers a full suite of products, right? Whereas on the TPO side, that independent mortgage broker, and that word independent is so crucial, right? That independent mortgage broker is so crucial, is that they are not tied to a specific shop, right? They are not tied to a specific lender, which means that they can go around to other wholesale, or TPO. You're going to hear that a lot, third party origination wholesale. They can go around to those different lenders and find products, pricing, find optionality for the customer, and really kind of negotiate with those lenders what their compensation can be, what may work better at this lender versus that lender. So the independent mortgage broker is really that. I mean, they are, independent in the sense that they have the optionality to shop around that customer to different places and really find the best deal that fits and that suits them. So that's the difference. There's a lot of back end stuff with servicing and secondary and, some other different things that happen. But, in the grand scheme of it, that's kind of what it is. Anything you want to backfill me with on that?
Yeah, I guess when I think about consumers, especially, I don't know why that anyone would ever want to not work with an independent mortgage broker, given the level of options that they have and the ability to find things that fit them. Like, what's a reason that someone would even want to go to a retail bank?
Relationships, right? Particularly with, and what you'll notice really is it starts at the realtor level, right? So it's like, Remax has, lenders that are sitting in their offices, right? And I'm just using Remax, but any of the real estate agents or real estate brokerages that are out there have some ties to some companies. Now, some are tied to independent mortgage brokers, which is great for us, right? But, it really comes down to that relationship where it's like, they may not have the best rate, but I know, Joe Schmo, and they have been taking care of me for 25 years, right? So I feel confident. And, in some instances, which I know this is going to sound crazy seeing that it's in 2025, and I think that the mortgage broker is getting pulled out of this, but for a long time, there was a black eye in the industry on who a mortgage broker was and what it was that they did. And then, The Big Short comes out, becomes a huge movie, and everyone still reframes and associates mortgage brokers with being shady shysters. You know what I mean? So
Yeah, and I guess if people actually knew the full history, they'd realize it's like all the big guys at the top are the ones
exactly,
even the former presidents of the Fed and all this other stuff. But that's neither here nor there. One other distinction I want to have you explain is the difference between just a standard broker and then one who would be in the non-delegated correspondent channel.
Yeah.
What's the distinction there? Is there any benefit between the two?
Yeah. So that's interesting. So yes, there are two different paths essentially in living in that broker space, right? Like you said, you can be a traditional mortgage broker, something very similar to yourself, and then you can be a non-delegated correspondent lender. And that non-delegated correspondent lender, you are acting as a lender. and you have a warehouse line of credit. Okay. So you have gone out, and if you can hear that noise, I apologize. That's my 3-year-old. It's his third birthday. He's excited.
Hey, I have 3 kids, and they've been in many a podcast.
Good. But they have their own warehouse line. Okay. So financially, they are, on the hook for funding that loan, turning that line, making sure that it sells. So it really is just a mini version of what, your standard traditional correspondent lenders do. The difference is, they have the opportunity to disclose up front, which means they can have their own disclosure platform. They can also have the closing side on that side. The middle is really the meat and potatoes, and it's that the person company that's going to be purchasing it, they're going to want to underwrite that to their standards, because we're going to buy that off of their warehouse line, repackage it, and then we're going to ultimately sell it to either Fannie or Freddie or to another investor, right? So those are the differences. The benefits, now that is a interesting topic, because some would say that the true benefit of that is more towards the loan officer, the company in general. It's more scalable for them to create different pricing incentives for different buckets. You have way more control over the process, especially the front end and the back end process. It's that next step in becoming, smaller mortgage broker, bigger mortgage broker. Then it's like, okay, let's take the non-Dell route. So, it's definitely a unique product. People are enjoying it, and it's starting to grow more than ever.
So you work with a ton of different brokers and loan officers. I mean, what are the loan products right now that people are underutilizing that you think they should be spending more time selling?
I'm so glad you asked this question, because it's ARMs. And I know people are going to listen and say, what are you talking about, ARMs? So believe it or not, ARMs are back. They're not as sexy as they once were, like the 5-1, the 7-1, 10-1 ARMs. A lot of them, and they're no longer using LIBOR, right? The London Interbank Offered Rate. It's now the SOFR rate, right? So that's the standard. And so they're no longer 1 year, they're 6 year or change there. But yeah, so there's the 5-6, 7-6, and 10-6. And why I think it's such a great product right now, especially on purchases, is because you can get yourself into some lower rates, right? Now, obviously, I want you to understand that this rate is going to change, right? So like, you got to explain adjustable rate mortgages and what that is, and it's going to change, and your adjustment caps and all that fun stuff. But if you're really focused and you're really rate sensitive and you're comfortable with the idea of refinancing it in a few months, or when the rates give you that window, take that option, especially as a first-time home buyer, because and if you're in that area median income, given where your location is, and you qualify for that, you can get a lower rate, and you can wipe out all of your loan level pricing adjustments still at the same way that you could for a 30 or a 20 or a 15. So don't think of it for the refis, think of it for the purchases, and then refi yourself into a longer term or a 15 or a 20, as you move forward, and these rates kind of find some balance. So I think that's one for sure. And I also think the 15-year, I think with where rates are at right now, the gap between getting a 30-year and what that payment is, right, at maybe, 50, 75 basis points different on rate, right, that you're going to be paying on a 30, and the amount that you're going to be paying on a 15, it's really small. And even a 20-year for that matter too. So know that there are different types of products out there, different type of amortization schedules out there. You can also, every single lender is doing this now. If you're in a current one and maybe you're looking to refi with a little bit of a drop, and let's say you got your home in 21 or 22 and there's still an opportunity out there, you can do a 28-year or a 27-year, right? And that also gives you some flexibility on your price and everything like that.
Is there any benefit for, I guess, either the broker to go lender paid versus borrower paid when it comes to their compensation structure?
Yeah, I mean, absolutely. So, going back to, call back to the retail side of things, a lot of the retail shops, loan officers' compensation is fixed. It's like, here you go. You can't negotiate it up and down, right? But, As a broker, maybe you have a tough customer. Maybe you have somebody that's, again, super rate sensitive, and you understand that they, may unlock a few other loans or a few other deals for you, and you're really big on the relationship side. Okay, well, I can flip over to borrower paid, match the rate, the spread from what the rate's being offered to that. So it's going to look like and feel like the lender is still giving, and they're giving you that credit to pay for your compensation. It just looks different on the loan estimate, right? However, you're able to drop your compensation down, be a little bit more competitive, put some flexibility in your pricing and really win that deal. And that's also a great thing for, if you're working with a good real estate agent, right? That's, you need to come in super tight. You have that optionality as a broker relative to what the retail loan officers operate again.
What's the best way you've heard it explained to a borrower when you're trying to explain the difference between these two options? When you're flipping it one way or another, how do you go about that?
Well, I always say, like, the only difference is the way that it shows up on your loan estimate and then ultimately your closing disclosure, right? So on the closing disclosure, it's going to be moved over to another section. You're going to see what that number is, right? So you'll know what that number is. On borrower paid on the loan estimate, now you're just going to see it up front. And then I'll show you down in the bottom section on the loan estimate, hey, that's the lender credit that they're giving me, the lender's giving me to pay for my compensation, right? So do you want to see it up front like that? And here it is. Or I can explain the exact same thing to you on the closing disclosure, and you'll notice that it's on the other side. Just because it says paid by the lender, it's the same thing. The lender credit and paid by the lender. I mean, those are the same things.
Yeah, that's good stuff. So, I mean, what have you seen recently that has been really working for brokers to grow their business in whatever aspect?
To be quite honest with you, and this is going to sound, odd coming from someone that is operating as a lender themselves. It's being a true independent mortgage broker. It's not getting tied down to delivering business to one shop, right? And what I mean by that is we have a tendency to love the shop that we're working with, or they offer a bunch of different programs, and I'm being very PC here, as you can tell, but it's finding the options that you're supposed to be finding for your customers and growing that base, building that trust with, a handful of different lenders that and I mean down to, I got a 740 FICO. It's going to be 20% down, W-2 borrower, clean loan. I know this is coming down the pipe, like, boom, I know who I can drop that off to 100% of the time. And yeah, it maybe it costs me a little bit more to drop it off there, or less, right? Or maybe you're going to a Provident Funding or someone that's really super aggressive, but their credit box is much smaller. Knowing that and being able to place your customers in there is going to develop trust with your real estate agents, right? And it's going to continue to grow. And then, the next part of that really is knowing when to push on the gas and knowing when to pull back. A lot of the people that I've seen grow and become successful in this have a very delicate balance of understanding when it's time to dial in with the real estate agents and work the purchase market, and when it's time to be super refi focused and, okay, I need to strike on those refinances, right? So you can't be too heavy in either side. You got to really make sure you're balancing that. And then too, with purchases, if you're doing the right things and you have the right CRM set up, right, the right client relationship manager set up, and the right tools behind that, and that's, shout out to Arrive. They do a great job with that, right? An absolute great job of making sure that you're staying in front of that customer. Then you can recapture that given the time and given the space, right? So that's really where it is. It's taking advantage of your technology, staying consistent in front of your customers, and that consistency in front of your customer is not only the future refi, but it's also stay consistent during your loan process, right? If there's something that you have going on and you got to run into it full speed ahead first, because your customer is going to appreciate that you took that head on rather than like trying to brush it under the rug. And I'm you deal with that way more than I do.
Yeah, no, that's a lot of good stuff there. I mean, when I first got into the broker space, I'm still on like sort of like the operations side, and I'm still trying to figure things out. And as I start to figure things out, I realize, like, why are you guys sending all of your loans to one lender? The whole point, I thought, of this was to be able to have options, because not every lender is going to have the same sweet spots. Not every lender looks at risk the same, so they're going to price different things more effectively. And I'm like, I want to be able to have multiple options for my borrower depending on what their situation is. Like, obviously I'm gonna have good relationships with certain people where I would prefer to send everything to X person or Y person, but it seems like there's a lot of value in understanding just the nature of the market and how it works to be able to have options. I think that's the
Well,
whole
that's
point,
the
right?
name of the game. You nailed it. You absolutely nailed it. And I just feel like we've lost that over these last few years because it became easy.
Yeah. I mean, and I don't want to speak ill of any lender, but I mean, there's definitely like 800-pound gorillas that seem to try to like dominate the market in one way or another. And to me, you can say you want to be about the broker, but that doesn't seem like that's good for the broker community and good for the consumer ultimately, to be able to have better options, more
Yeah, I mean, there's
options.
lawsuits pending in Ohio right now with that 800-pound gorilla as a result of, what is believed to be steering in
Yeah.
some form or fashion, right? I don't know any more or less than that, but to your point, your job is to truly find the best spot for that customer, the best option for that customer. And that's what you need to do. You got to go out there and find it,
Yeah.
find that shop. So yeah, you nailed it. You nailed it.
And you mentioned Arrive. I do love Arrive. So I worked in mortgage tech for a while, and I've worked with a lot of really bad LOSs. Arrive is awesome, and I think they really get it. There's no perfect LOS out there that does everything that you're going to want to do, because it has to be sort of like an all things to all people in some ways
Right.
product, because you have to have a lot of people. So there's always going to be stuff you're annoyed with. But on the whole, I mean, the product is amazing. What it does and how it functions is really, really good, especially for brokers, in my opinion.
Absolutely. And it's come a very long way, right? So when it was first rolled out, I mean, there was a lot of kinks. There was a lot of things that needed to be worked on and kind of flushed out. And they've done all of that. And, they're continuing to grow at a big clip. More and more lenders are going in there. It's, like you said, it's not only a benefit to the broker yourself in terms of what it is for an LOS, but it's also becoming a world-class pricing engine, which is rivaling, some of the other big ones too. So yeah, they got a great product over there.
Yeah, no, I mean, I think I love Optimal Blue and the people there, but their product, it definitely looks like it was built in 1990. Like, it definitely works. It just
Yeah,
doesn't look as clean.
right. And for sure. And I mean, nowadays, I don't know if you're an iPhone or an Android user, right? But I say this all the time to people that are iPhone. My dad refuses to switch over. He's been Android forever. He's like, no, I can't figure it out. I said, Pop, the thing about the iPhone is you say that you'll have it in your hands for like 2 or 3 hours maybe, and you'll figure it out. It's
Yeah.
designed to be that easy. And people are looking for that now, right? I want to look for something that's easy to use. And I don't, like you said, with Optimal Blue, it's like there's still like these little, carrot drop down things. Like, what am I doing here? So,
Yeah, you're
um,
giving me too many options, especially for a lot of loan officers who don't know they know the basics, but they don't know like all the stuff that's going on there. That it can look intimidating
yeah.
and look overwhelming to see this many things and not know where to put things. One other thing you brought up was that focusing on purchases versus refinances. I got into the industry at a primarily refinance driven shop.
Yeah.
So I didn't understand what a purchase was or how that worked until I left there. And I remember when my wife and we got pregnant with our first, and we were trying to move closer to her family. And I'm like interviewing at other lenders, and I I don't know what I was thinking. Well, I didn't know. I in the middle of the interview, it's a bank doing purchases,
Yeah.
and I just remember during that period where I was at, it was all refinance driven, and they're just like giving like free 15-day lock extensions over and over. They didn't care. And I asked the question of like, do you guys like pay for lock extensions? Like, does we do that all the time? And I remember, like, now that I think back, I'm like, that's major red flag
Yeah. Right. Exactly.
to talk to a purchase and say we need a lock extension for it. But
Don't want that.
I had no idea how to switch from the two. And when I see the ups and downs in the refi market, you're really impacted, right? Because if you're
Extremely.
dependent on the market for the rates, you've got nothing there. It seems like people who understand how to do purchases have a much more sustainable business model.
Oh,
Am I-
you're spot on. You're spot on because look, you're always going to need we're always going to need to put Americans in homes, right? So that is always going to be the case. And, refis come and go. And the thing about it is, and I've said this a bunch of times to, some people that Josh Teddy, Josh Teddy, right? So I tell him this all the time. I was like, that was what we experienced in 2020 and in 2021 was a once in like a generation thing that just doesn't happen. And there are people operating out there, brokers, account executives. I would say there's executive management that are still operating as if we are living in that bucket of success that we had. And it's going to come back and people are going to, guys, you got to wash that away, right? It's like those things aren't coming back. So you got to get back to the basics. And the back to the basics is focusing on those purchase transactions, building relationships with those real estate agents, because we're going to need to continue to put bodies into homes, right? I think the housing market makes up the largest portion of the GDP, right? So that is what we're going to focus on. That's what we do, right? As Americans, we have the best housing market in the world. So we're going to continue to do this. Are we going to have to get creative with how we find better financing options when rates are up in this market or this percentile that they're in right now? Sure, we're going to have to get creative. That's why having something like an ARM in your back pocket or understanding the 15-year a little bit, or having some of these other more unique DSCR programs or some bank statement programs, some things that, might not be as traditional as what we're used to, having that and having those options, it's the best thing, because, you're operating kind of like how we are, right, as account executives, with going out and managing, like, yes, the borrower is your customer, but so is that real estate agent. Right? You're operating in that space. So focusing on that, understanding that, refis are cherry on top, right? But your bread and butter is that purchase market, and understanding that and living in that space. I mean, that's where you got to be. So,
yeah. So my last question would be on real estate agents. I mean, what, in your experience, how have you seen brokers be successful in building relationships with realtors, whether it's a non-existing relationship or it's an existing one that they've enhanced and been able to get more business from them?
Well, it's so funny because it's just, like I said, there's so many parallels between what you as loan officers and originators go through and what we do. I mean, that first deal, say you're pounding a real estate agent over and over and over again. You're in their office, you're taking them to lunches, you're doing all the things, right? You're doing everything right, you're staying in front of them. They're going to take, when that opportunity comes, they're going to take and they're going to blow the dust off of a loan application or like, I've been trying to get this person into a home forever, and they're going to try to hand it over to you and say, hey, what can you do for me? So in those instances, it's either somewhere to go to, right? Because you have your book of lenders and you get it and you can find the right spot and place it, or telling them, no, I looked at it. I can't do it. I want to, trust me. I really want to take this opportunity and make the most of it. But I'm not going to be able to because I just can't get it done. They respect that. They may not love it because they want it just as much as you do, and we want to get the borrower in a home, but learning how to tell them, I'm sorry, I can't do it. But I mean, it really comes down to the same thing I said before. It comes down to consistency, making sure that you are staying in front of them, doing everything that you can, communicating up front. If things aren't great, be consistent in your service level. Resiliency. You're going to get good ones. You're going to get bad ones. Build your bench of real estate agents. When I say good ones and bad ones, loan applications can't do it, whatever the case may be. So you might upset somebody. That happens. That's part of this industry, right? So stay resilient. And then you got to have the drive every day. You got to make sure you wake up in the morning and you know why you're doing this, right? And what you're doing it for, whether it's your kids, whether it's, financial stability, whatever the case may be. Just make sure you're putting those three things at the forefront of your mind every single day, and the rest is going to take care of itself.
Yeah, that's good stuff. Well, Matt, I really appreciate you taking the time here to talk with us. I think education is just its power. It empowers a lot of people, and there's just not a lot of resources like this available for mortgage lenders, for consumers, for everybody in between who are curious about these things and want to learn more, educate themselves. And so I love taking opportunities to do this. So thanks, Matt. He's with Union Home Mortgage. Go check him out. Their team is awesome, fast, efficient, effective, and just the right amount of keeping up with me. I don't like you to call me every day. That's crazy. I don't know why some people do that. I'm like, I'm trying to get business.
Right. I got work to do.
You're taking me off the floor.
I got work to do. Jordan, thank you so much. I really appreciate the time. It was great speaking with you.